Hi everyone, this is a short screencast for Independent Colleges Dublin for F6 taxation for December 2014. And in this particular and final screencast, we're going to be looking at question 2, the corporation tax question. And I'll be taking you through some areas that I think are most likely to come up. We won't be covering everything in this short screencast, but we'll certainly be covering things that will come up on the day, I'm sure of that. Okay, so as with before, I have sort of three sort of main core areas as you see here. And these are the most commonly, most common approaches, I guess, to a CT question by your examiner. So let me just go briefly through the first area for you. This is the tax-adjusted trading profit. Now, I know that you're familiar with, broadly speaking, how that works, and that obviously we're going to have some sort of starting point. You need to be careful on that. This is really the core area here. This is really where the marks are. In other words, the add-backs, and they're bound to be one or two on the day, if not more, that may be presented to you in a way that you haven't seen. So you just have to be very, very careful. There's some very easy marks to be had there for the more simplistic ones, and perhaps one or two more difficult marks. So the key point, as I say in classes, is to make a decision very quickly as to whether or not the item is allowable or disallowable. Now, obviously, sort of impacting on the tax-adjusted trading profit for companies is this area of capital allowances. Now, I've covered the nuts and bolts of capital allowances in the Q1 income tax theme, so I'm going to concentrate here on industrial buildings because obviously this is associated with companies more often than not, and it's a favorite area of your examiner, and I've set out really three sort of main elements to it below, so hopefully you'll be able to understand how he may come at you. Okay. In terms of the sort of second part, I expect that we'll be asked for some sort of computation. Now, the computation side, I think, is probably one of the more easy elements because we're familiar with a corporation tax computation in the sense that it's very much a list, a list of income, possibly one or two adjustments, maybe a trade charge as a deduction, the application of some rates. So I would have thought that this middle area here is a key area for you to sort of pick up some marks. Do bear in mind that even if the case one adjusted figure, the case one income is inaccurate, it's not 100% bang on, you'll be method marked here, so you won't be penalized for using an incorrect figure, let's say from part A above. Okay, so do follow the prescribed format for a corporation tax computation. Apply your rates to the relevant income, and obviously don't forget to bring in any other income from your part 1 or from your tax adjusted profit. That's often a mistake that I see students making. They may well deduct other income because it's not case 1 relevant, but they'll forget to include it in a corporation tax computation. One of the things that we get quite often is dividends, and this is the classic trick, the idea of dividends from other Irish companies, and they would certainly be exempt. More of that in a moment. And as I mentioned above, just the rates, the split between the normal rate of 12.5% and the items that will attract a 25% or a higher rate. Third part here is losses and groups. I'd be very surprised if losses aren't examined from a corporation tax perspective. Maybe groups less likely, but certainly been examined in the past. I think the key area here is losses, and we need to be familiar with the order of set off and the little sort of rules and nuances, say compared to losses for individuals. The value base is obviously key for us within corporation tax. We need to know what that is and how to apply it. And then the last point I've mentioned is just this idea of groups. Obviously, this whole area of groups to a large extent centers around the surrendering of losses, but also there are one or two other areas, perhaps a formation of a group and indeed capital gains groups, which doesn't tend to be examined in a computational sense too much. I wouldn't rule it out, but more in the sense of what can happen, what's the upsides of companies being in a capital gains group. So essentially, those are the three sort of core areas. I'm going to give you a little bit of detail now below in relation to what I feel would be sort of most likely to come up under those headings. I mean, the list that I'm going to provide you with is certainly not exhaustive. There are other areas within corporation tax that could easily be examined, but I certainly feel that several of these are fair game. Okay, so if we look at the tax-adjusted trading profit first, I mean, essentially, our starting point is invariably a net profit. Okay, so we'll be presented with a sort of a mini trading and profit loss account, and we'll just have to find the net profit. But be careful there, because it may well be that the examiner doesn't present it to you on a plate, or that you may sort of be inclined to pick up the wrong figure. I mean, do bear in mind the examiner could start with a net loss and recognize how that would reverse the entries in our add backs if we're starting from a loss position. In effect, if we're sort of adding back expenses, and in effect disallowing expenses, we're going to be reducing that loss as opposed to increasing a net profit. So just be careful of your starting point, and even if it is a profit, be careful what's included and what isn't included. It may well be that some items in the notes may not be reflected in the net profit, so there would be no requirement to perhaps add them back or deduct them or whatever. Okay, so just be careful with your starting point. We're going to get half a mark minimum just for getting the right starting point, so let's make sure we do that. Now, here's where the fun starts, really, in terms of the add backs. Now, I haven't listed every single item for certain, because there are a multitude of expenses that the examiner could use. So I picked out the main ones. I'll run through them in a moment. What I've said here, I've sort of started with other income, and the reason that I've started with other income is that where we have other income included within a net profit figure per set of accounts, all of it is always going to be added back. It's always going to be added back because obviously it's not accessible under case 1 rules. Now, students tend to, or some students certainly tend to forget that. They tend to forget that other income needs to come out at all, or if they do, perhaps they pick 1 or 2 items. I mean, our rule of thumb is that other income isn't case 1 income, therefore it must come out. But do remember what I said above about, let's just say that we had a part B, which was a corporation tax computation. We need to ensure that we bring the other income into the corporation tax computation, obviously if it's relevant. For example, dividends from other Irish companies would be exempt, so we would just show them as exempt. But so just watch out for that. Okay. Now, in terms of the expenses, I've just picked out 5 or 6 or thereabouts. The first one, I would say maybe is probably the most likely one to come up outside of perhaps depreciation. This idea of pensions, and we're only interested in what's been paid, what has been paid by the company in the year. So any opening or closing accruals are irrelevant. And I think the safest way to deal with pensions and finding that payment, because it certainly won't be handed to you on a plate, is to do just a simple T account. If you can do it in your head by adding and subtracting the accruals, then fine. But a T account doesn't take long to do, and you'll probably find that more often than not you'll get the right answer. You will, by using the T account, which takes a little bit longer, you're nearly guaranteed to get the right answer if you know your sort of debits and credits. Okay. Next point here is interest. Very often you find this within the CT question in terms of an add back. We're only interested in anything to do with the trade. It's just the trade. So watch for that. We're looking for items that are trade relevant. Okay. Obviously, I'm talking about interest payable. Okay, on loans, or perhaps bank overdraft is a classic one that will invariably always be allowable. It won't be added back. Depreciation and amortization, I've said don't forget because students do. I mean, that would probably be, if I'm doing my own add back, the first one that I put down, because that will be easily recognizable from the trading and profit and loss account. Watch out for amortization as well. That's the same as depreciation, so it's got to be added back. So let's not lose easy marks. These are marks really for doing very little and for knowing very, very little, and we need all of those easy marks for sure. Okay, moving down the page, entertaining. Again, a bit like pensions or perhaps depreciation, I would be very surprised if there's a CT add back question that doesn't include some form of entertaining. And, our rule of thumb is that we're going to add it back, all of it. We're going to add back anything that smells or smacks of entertaining. But just watch out for this area here. This tends to be the classic trick, this idea of entertaining relating to staff, normally in the form of a staff party, a Christmas party, a summer party, any sort of party. That is okay. That is fully allowable. So just watch for the difference between the two, client and supplier on the one side, and on the other side, staff. Staff stands alone and will be okay. Next one here can be a little bit tricky, and the reason that I've included this is obviously that in certain cases we'll have an add back, but also in one particular case, subject to the value of the car, we'll actually have an additional expense. Now I'll draw your attention to page 190 of the text. Have a quick look at that if you can in terms of car leasing. We're talking about the lease of cars, obviously not the ownership of cars. And what I've seen the examiner do from time to time is perhaps put in several different cars. One of them is owned, the other is leased. So just be careful. This add back, this provision relates to leasing, either an add back or possibly a further deduction. Okay. Next point I've listed is bad debts, and we should know that specific bad debts are always going to be allowable. Okay. Just bear in mind with that is, given that rule, they're allowable. If we did have the recoverability of a specific bad debt that had been written off. So last year, for example, we wrote off a debt of €1,000 to ABC Limited. Okay, if that were to be recovered, in other words, if the ABC Limited were all of a sudden to send us a payment for 1,000, that would be a credit, obviously, into the P&L account. So in effect, a sort of reverse expense. So watch out for that as well. What I've specifically listed here, though, in the bad debt area is provisions. Yeah, and obviously we can have an increase or a decrease in a provision. So watch out for the adjustment based on that. We're certainly not going to be allowing any increase in the provision as a tax deductible expense, and we're obviously reversing that sort of set of rules when we have a decrease in the provision, in effect a credit. Okay. So that's really the sort of the 4 or 5 or even 6 add backs that I would be watching out for certain. Okay. Now next point is this capital allowances area, and just bear in mind what I said on the intro here. I'm focusing in on industrial buildings because that's what tends to come up, obviously along with your standard wear and tear allowance, equipment and fixtures, etc. But I'm focusing here on industrial buildings, and I've given really sort of 3 main areas or 3 main ways that the examiner can come at it. Now this way here I haven't seen too much. In other words, what we're saying is that the company in effect self-bills, or indeed pays a construction company to build it for new, or indeed from new. And really the trick here is, what is the qualifying cost? In other words, what is the cost that the company can apply their 4% to over the next 25 years? And the main trick is this 10% trick. In other words, this idea that a variety of items are allowable. Obviously we exclude the site cost or the land cost, but a variety of items are allowable, leveling the land, etc., etc. But what I could see the examiner doing is including 1 or more likely 2 of these items. In other words, this area where we have to compare the value of the shop and the showroom to this 10% of the underlying cost. Yeah, and if it's more, then they're excluded. If it's less, then they can be included, therefore increasing the qualifying cost. So do look at that quickly if you can. It wouldn't take long just to get a grip on that and just look at the types of costs that are included in the ordinary sense of the word, qualifying costs. But just look at this little trick. There's a good example in the text on that that will show you how to work that. I call it the 10% trick. Okay, but if in doubt, certainly don't deliberate or delay. If in doubt, make a decision either way. Either these items are going to be included or they're not. Make a decision, apply your 4% and get that 4% into your computation. Okay. The second one here is just this buy second hand, and this is the one that I've seen more regularly than certainly the self build. This idea of a company buying an industrial building when it's part the way through its 25-year life. Yeah. So in other words, I guess the question is how much are they allowed to deduct as a industrial building allowance, an annual allowance, in each of the years going forward. So let's just say that 5 years have passed, and that's what we need to know. We need to know, when was the industrial building put into use? What year was it? And how many years have elapsed since then? Once we know that number of years, we take it off the 25, and then the qualifying cost, which should be given in the question, we simply divide one by t'other. Okay, so watch out for that. The third way is sort of linked into number 2 in the sense that we need to know the number of years, is just this idea of the disposal of an industrial building. And let's be clear here. I mean, in effect, what we're saying is that we purchase a building or we built a building. It's qualified for industrial buildings allowance. We've perhaps taken the industrial buildings allowance over a period of time. Let's say again it was 5 years. I mean, every single time that happens, if we dispose of the building, it must be that there'll be a balancing charge, because buildings are not going to reduce in value. So in effect, what we're saying is that whenever we dispose of an industrial building, what we've got to do is calculate the balancing charge. Now, we'll be aware from our sort of previous studies that a balancing charge is in essence the difference between the proceeds and the tax written down value. But here, because of the fact that we will have a large increase, we'll see that in effect the value of the balancing allowance is going to be all allowances given to date, all allowances. Okay, so just watch for the disposal of an industrial building, and just recognize that all you really have to do, a shortcut as it were, is calculate how much this company has received in terms of annual allowances or industrial buildings allowance since they had the building in use. Okay, so those are the sort of the 3 main areas. I would say that this one and this one are probably the most likely, but don't rule out this one. This hasn't been examined for a while, so I think it's certainly worth looking at, and do they all are. Okay, next point now, the corporation tax computation. This is, as I mentioned above, I think an area where we can get some good marks and hopefully fairly quickly. We're aware of the fact that the corporation tax computation is obviously going to include our case 1 income. So let's assume that part A was an adjustment to profits. We had to calculate some form of capital allowances or industrial buildings allowances, maybe other capital allowances. So we had our case 1 income, from part A. So we're just going to include that figure. Yeah. Now bear in mind what I said above about this method marking. Even if it's wrong, you're not going to be marked down for it a second time. Okay. So just really slotting the figure in, the case 1 income figure in from your part 1 or your part A, you're going to get half a mark just for doing that. Okay. So again, marks for very, very little. Okay. Now, this area of other income, this is important. I mentioned above this mistake, unfortunately, that students tend to make, where they're doing the adjustments to profits, they'll exclude or deduct, hopefully, all of the other income because it isn't assessable under case 1. But they may forget to include all of it, or indeed some of it, within the corporation tax computation. So just be careful on that. Okay, it may well be that if you've got your pages set up, let's say page 1 for your adjustments to profits, page 2 for your comp, you could well do both things at the same time. It doesn't matter what order these go in. You could put in your other income as you're deducting it from the add back page, your page 1. Picked on a few things here. This is a classic one, this idea of dividends from Irish companies exempt. Do make sure that you put in the relevant narrative and say exempt. Otherwise, your market doesn't know if you just forgot to include this element of income. So, put in Irish co exempt or dividend from ABC, exempt. Okay, and obviously a 0 figure. In terms of the rental side, rental side is as likely to come up within CT as anywhere else. So, I did cover rental income rules in relation to the IT themes or income tax themes on video 1. What I've picked out here is just a couple of things, just a premium. Our premium formula, we really got to know that and be able to lay that out very quickly. The other thing that I've just touched on here, again, it's relevant to income tax as well as for companies, is just this idea of post-letting expenditure. There's absolutely no chance that rental income will come up either for companies or on a case-by basis for individuals, with the properties being let for a full calendar year. It's impossible for that to happen. So just watch out for the post-letting element, because that's what's relevant for letting purposes. Okay. Next one here, just in relation to this area of other income, is gains. Yeah. Now we should be familiar with this sort of grossing up of gains by our little fraction. Don't forget to do that. It's a common error. Obviously, bear in mind that development land gains would simply be taxed at the normal rate. We don't need to gross them up. They would simply be taxed at the 33% rate. Okay. The next point is just the rates. So far we sort of had slot the case 1 income in, slot the other income in. I haven't dealt with any trade charges or any adjustments or any deductions as such. I'm just going to go straight to the rates, and I've just said just watch out for your application of the rates. You're going to get some good marks there, perhaps half a mark for each item, and if you've got the incorrect figures, you will still get marks. So make sure that you try and allocate proper rates to the right sort of income. Okay, so next part is just this groups area, and again I would expect that as mentioned above, that if losses do not come up in one way, shape or form, it would certainly be a very, very odd paper, and I would favor losses, well, across the board, and certainly for corporations or for corporation tax losses of some way, shape or form. Okay, so what I've done here is just split it into two. The first area is just losses for companies. In other words, losses for individual companies. And as we've said in classes, we've sort of got a little bit of a dance that we do here in terms of back, forward, backs. We know that we can go back against, well, we can set a trading loss back against trading income. And once we've done that, we come forward on a value basis against other income, and then back on a value basis against other income in the previous year. This value basis is key. I'd be very surprised if this is not examined in some way. I think it's highly unlikely that there's not going to be other income available to be offset by losses. So be clear on what the value basis is, and also this is key for you to get those extra little marks. Your formatting. Where losses are concerned, one way or another, we're going to have, a CT comp for the company, or indeed companies if it's a group issue, and indeed a loss memorandum. Your marker is going to expect to see those two things, so make sure that you provide them. And certainly the loss memo does create a way of you sort of allowing for deductions from the total loss, so it makes sense to do it anyway. Okay, so what's your format there? Okay, next point is just groups. Not too much here. We should be familiar with that 75% percentage, and also just with the slight difference between the formation of a loss group and a gains group. Remember that gains groups or capital gains groups are easier to form because we're simply looking at a company and its 75% subsidiaries. We don't have to have any sort of walkthrough each of the companies maintaining at that 75% level, whereas for a loss group we do. In other words, we have to maintain that effective interest all the way through the group. Okay. Now, I don't think this is a big issue for us, because I think that the standard way at F6 that the examiner comes at this is that he'll give you the groups. In other words, he'll tell you that company A owns 80% or 85% in company B, etc., etc. So we don't have a major problem, I don't think, with forming the groups. I think what we need to do is to understand why companies want to be in groups, and what the upsides, i.e. the advantages, are. And really with the loss groups, we should know that we're going to have a claimant company and indeed a surrendering company, and we're looking simply to surrender losses from one to the other. Okay, bear in mind that the company who is doing the surrendering needs to offset against its own losses, or own profits first even. And watch out for the fact that preferably the year ends run coterminously. In other words, it's only current year losses that are relevant. Okay. On the gains group side, we should be familiar with our old no gain, no loss rule, and that's really the big upside in relation to being in a gains group. In other words, the companies can transfer assets from one to t'other and have no gain impact, no sort of corporation tax on gain impact at all, as long as they remain in the group. Okay, so just watch for that sort of upside, and also watch for the little trick that the examiner tends to play, where, let's say, we have a loss in one company and a gain in another company already crystallized. And you may have seen this previously in other questions. There may be a question in the area of whether or not the loss in one company, or the capital loss in one company, the gain in another company, can be offset. Well, they can't be, because we cannot transfer gains and losses. We can transfer assets. So really, it's a timing issue, isn't it? We could facilitate an offset of a gain with a loss by making the transfers before or before the event, as it were, or indeed really transferring assets, crystallizing gains and losses, and then offsetting them, rather than looking at it in retrospect and saying, well, can we move this loss to this company that's got a capital gain? We cannot do that. So advanced planning is required. Okay, so that's a sort of a basic summary. As I say, there are other areas that could feature that I haven't covered, particularly on the admin side, but I thought I'd focus in on the number crunching, because I think that's the hardest element of corporation tax. Certainly a little bit harder than VAT and capital gains tax, and certainly on a par, if not harder than the income tax area. So hopefully that's been a decent enough summary for you, and good luck with your studies.